Hi guys, it's Jessica Stone at Stansberry Research, and I've got Matt Weinschenk, and we're going to be talking about how to trade options and what are options, because there are a lot of new investors getting into the market. We're filming during COVID-19 and the shutdown, and people are looking for ways to make money. This is one of them. Matt, can you talk first of all about what are options?
Options are, I like to think of them as a side bet, right? If you like horses or horse racing, you can buy a horse and own it, and when the horse wins, you'll win money, right? That's like owning a stock. If the stock does well, you do well. But there's also all these people betting on horses. They don't own any horses, and they're saying, "Hey, I'll put my money in, and if the horse wins, you give me this." And there's all these agreements that are side bets. And options are the same thing. You don't have to own the stock. But you can bet on its success or failure, and you can bet on it, in a leveraged way. You can take a small amount of money and turn it into a lot of money if you're right. But you could also lose all your money quickly because that's the effects of leverage that you have to learn to deal with.
And options prices actually move differently than stock prices, right?
Well, there's a lot of reason option prices move. The first thing you would think is they move more in general, right? If a stock moves 10%, you can find an option that moved 100%, which is great if it's moving the way you want. They also move depending on volatility, and they move depending on time. And those are things that you have to figure out as you go along, because they do have effects on the price, but they also allow you to bet on different things. You can make money from time passing. You can make money from volatility changing. The short answer is, it's a lot of people are getting into options today because it's exciting, because they move fast, they move a lot, but you have to, you can manage those things, and you have to position size and things like that. But that's what gets people interested in options, and it also is what leads people to quit options because they don't figure out just how volatile they can be.
So then why, besides being an adrenaline junkie, why would somebody trade options?
Okay.
What's the pro, what's the con?
Yeah, sure. So I'll give you another analogy. Think of a home building company, and they used to buy these huge swaths of land for millions of dollars, and then they would try and build homes on them, and then they would try and sell them. But there's a huge time in there, right? So they might put $2 million to buy land, and then they have to sit and wait and get all the other stuff, and sometimes it falls through, the market changes. But what they do now is they'll buy an option on the land. They'll go to the landowner and say, "Look, I want to buy this for $2 million, but I just want the right to. I'm going to give you, I don't know, $100,000 today. And now I'm calling dibs on that." So options are the same thing. They're the right to buy an asset at a price in the future, and you pay for that right today if you're essentially a call buyer, right? So now they don't have to put out $2 million. If the market changes, if they never build any houses, they don't have to put up all that capital. They've put a little investment in, and they have an option, right? They have flexibility. So to move that back to the stock market, if you like a stock that's at $50, you can pay, let's call it $1, to buy, for the right to buy that stock at $55. Okay. Mm-hmm. If the stock goes up to 60, you have the right to buy at 55. So now you that's worth $5. Your $1 turned into $5. If it doesn't go up, though, your $1 turns into $0. So the stockholder, the stock might go from 50 to 60. They make 20%, or they might stay flat. But you've got a leveraged bet. So you have the right to buy, and you can turn that into a lot of value depending on where the stock goes.
You mentioned earlier the word call. There are calls and there are puts. What's the difference?
Short answer, a call buyer is expecting the stock to go up, and they want that's that 50 to 55. The stock's at 50, and I want the right to buy at 55. A put buyer is betting that the stock will go down, and they want the right to sell. So the stock's at 50, they might want the right to sell it at 45. If the stock goes all the way down to 40, they can still sell at 45. So you can buy puts as protection if you already held that stock, or you can buy it as a speculation that a stock will go down. So calls going up, puts going down, calls right to buy, puts right to sell. It gets complicated, but once you get these things down, it becomes
Sure, Matt, sure.
Yeah, it does.
But one thing that's interesting to me is that you actually use calls and puts to manage risk inside of a portfolio. You sort of alluded to that before, but it's not just about quick making money. It's also about protection if you use it in a different fashion. So there's a dual purpose, or maybe a triplicate purpose for these tools.
Exactly. So we run a couple different strategies, and one of those, it's a covered call strategy. It's relatively simple, and we would consider it for new option traders. But what that does is that takes stocks. We take sort of blue chip, steady stocks, and we sell calls, which means we do limit our upside, but we generate income from them every month or every other month along the way. So it's actually a risk reducing strategy, right? A lot of people use options to speculate and ramp up their risk. This strategy uses them to reduce risk, and you can do all sorts of different. You can make all sorts of bets on different outlooks. You can expect the stock to be volatile or not volatile, or go up or go down, and you can make all sorts of combinations. So yeah, we use them to reduce our risk and generate income from stocks that might not pay large dividends. So it's a conservative strategy, which you can do with options just as easily, probably easier than you can speculate with them.
Well, we'll come back to you for other explainers, Matt. We appreciate your time. And if you would like to see much more educational content like this from Stansberry Research, please subscribe to our YouTube channel. You can also find us on Facebook, on Twitter, and on Instagram. Thanks so much for joining us. We'll see you next time.